Hi friends, welcome to A to Z Accounting Pro. So this is our first video. This is all about accounting and finance lessons. First of all, it's free classes, all free classes, and we will be covering the accounting cycle of a corporate company, full the whole accounting cycle of a company, of an LLC company. So here, this is the first introduction page. I'm just want this is our logo, and our motto is free videos on accounting concepts. So that is mainly this free videos on accounting concepts means there are a lot of videos available in uh, uh, everywhere on the websites and all other social medias. But this is what we offer is something different, that we are providing from 20 plus years of experience to finance and accounting professionals. So these are not just we are reading the textbooks, or not we are just explaining the textbooks. These are practical, only practical experiences from our own experience. So and also lectures means it's not only from textbook. These are the practical thoughts and discussions to understand the concepts easy and a better way. And also, as I told you, we will be discussing the full-fledged company's whole accounting cycle, okay, accounting and finance cycle, through a series of videos and with a live practical on it. So live practical means we'll be discussing the complete journal, the full journal entries required to close the month and to close the year for statutory audit and all. Okay, now the targeted audience here are the accountants, job seekers in accounting, students, accounting, finance, and commerce, and all the professionals who are younger in their career, still wanted to enhance their career in accounting, and whoever wanted to learn the concepts of debit and credit, the concepts of finance, the concepts of complete accounting cycle of a firm, or the startup companies accounting cycle. They can join here, subscribe here, and watch the videos. And you can also make your own comments, and if there is any further requirements, you can also contact me in person. Okay, now the points, today's points we are going to discuss, these are the 7 points we are going to discuss these 7 points here: debit and credit explanation, and legal structure of an LLC company, capital injection of an LLC company, preliminary expenses, how we are going to treat the preliminary expenses, stock purchase for credit and sales for credit, also impact of all those transactions in company's financials. Okay, let us move forward again with the first point: debit and credit explanation. Debit and credit explanation, I don't need to tell you in detail, but still I'm going to explain this one briefly. So the golden rule is here: personal, real, and nominal. So the personal accounts are individual accounts, debit the receiver and credit the giver. Real accounts, what comes in, and debit what comes in and credit what goes out. And nominal accounts, debit all expenses and losses and credit all incomes and gains. These are the written golden rules. But here, to understand this better, this let us read the above rule together with chart of accounts or trial balance of the company. So we are not in a class, we are not in our college, we are working, we are the working professionals now. So even if you are a student now, so you think like you are working, so how practically you can perform the accounting of a firm. Okay, now here, in accounting there are 4 categories, mainly assets, liabilities including capital, revenue, and expenses. assets, liabilities, revenue, and expenses. Okay. So first of all, we need to create a chart of account for a company. What is chart of account? Chart of account means the record accounts. Whatever company's requirements, we have to maintain the series of accounts. That is what is called chart of accounts. There is no, because we can maintain our own chart of accounts always, and those chart of accounts must include assets, liabilities, capital, revenue, and expenses. So here now I will show you one simple example of a chart of account. Here these are the a simple example for an LLC company chart of accounts. So most of you already knows this. These accounts are called asset accounts. Assets. These are all assets accounts. Petty cash, bank account, security checks, staff advance, inventory, and property, plants and equipments, and prepayments are all asset accounts. And the next part is all covering liabilities. These are all liabilities. Okay. And the third one is equity, or whatever we call capital equity. And the fourth segment is revenue accounts. So these are all revenue accounts. So you already knows this. And the remaining last ones are expenses. So here I have categorized those. These are GL codes, general ledger codes, and account names, and these are major groups. These are subgroups. Okay, for example, you can see petty cash, where it goes to the major group. It's cash and bank balances, and the subgroup is cash on hand. Subgroup here for the bank is cash in banks. At the same time, both cash, cash in hand and in bank account goes to cash and bank balances. So this category will go to financials. Financials means trading, profit and loss and balance sheets. So this category, the whole category, all this category will go to our financials to prepare the financial. These are the mapping of the individual accounts. Okay. Now let us go back here. I have written here assets. Any increase in asset we have to debit. Any increase in liabilities we have to credit. So any increase in asset we have to debit, any increase in liabilities we have to credit, and any increase in revenue you have to credit. Any increase in expenses we have to debit. So let us go back then again. Let us see here. These are the asset accounts. Any increase in any one of these accounts, any increase in any one of these account we have to debit. No doubt. Okay, again here all the liabilities, any increase in those liabilities accounts we have to credit. Here these are capital. Any increase, again any increase in those capital and retained earnings, whatever these accounts we have to credit again. Okay, now an increase in asset we will debit, any increase in liabilities we will credit, those concerned accounts we will credit, and any increase in liabilities also same like, capital also same like liabilities we will credit. Okay, now any increase in revenue also we will what we will do, we will credit. Any increase in revenue also will be credited, and any increase in expenses, all those expenses accounts will be debited. Hope you understood all these concepts, and these are Same like same the same criteria of golden rules. Okay. Now, what are the accounts to be debited? Assets and expenses. If there is an increase in assets, any of the assets account or any of the expenses account, debit those concerned accounts. For example, okay, if there is an increase in salaries expenses because we are paying the salaries of this month to our employees, so there is an increase in salaries, means debit that account, and credit if you are paying cash, credit to the cash, or if you are paying through check or other transfers, credit the bank account. Okay, so let us summarize this. Increase in asset debit, increase in expenses also debit. So now if there is a decrease in asset, then I don't need to tell you, it will be decrease in asset will be credited, decrease in expenses will be credited. Okay, again, increase in liabilities will be credited. At the same time, if there is a decrease in liabilities, then it will be debited. Okay, the same way here, capital also, any decrease will be debited. And here in the revenue, any increase in revenue will be credited, so any decrease will be debited also. So this is actually, this is the correct golden rule of accounting. So if you have a chart of account in hand, then that will be fine. Then once you have you know independently managed to enter 2-3 journal entries, then you will have you'll be more capable of doing all those entries hands free and independently. So you don't need to worry about all those things, but just understand the basic concepts. Basic concepts means any increase in asset or expenses, debit. So vice versa, any decrease in expenses or assets, credit those concerned accounts. The same way, any increase in liabilities or capital, credit, and vice versa, any decrease in liabilities or capital, debit. Okay, so that is what is called golden rules. And the golden rules here, we have already learned this one during our graduations or certifications, whatever. So these are basic accounting theories, just for your information, because these things, if you don't know these basic where what you will debit, and where when you when an asset is increasing, what will happen. And first thing, you have to understand the actual transaction, what happened during the transaction. Okay, now for that one, I'm going to explain another legal structure. Okay, legal structure means we are going to open a new company called ABC Company Limited. Okay, it's a startup company. We are just starting the books and accounts of this company. Okay, now for the accounting purpose, a company is defined as an artificial person having corporate legal entity distinct from its members or shareholders, whatever. An artificial person having corporate legal entity distinct from its members. So this is the defined terms in our textbooks. Now, what does that mean? Being an accountant, let me tell you how you can assume this. Okay, being an accountant in this ABC Company Limited, you assume that you are the artificial person. company is not, I mean, there is a company, but you assume that you are ABC company and act like the company, not like an outside person, not like an employee, not like an owner, but act like the company itself. So, being an artificial person, what will happen to you during those transactions? Then you can, understand the concept, underlying concept of each and every journal entries properly. Okay, now here the partners are four partners here, A, B, C, and D. Their shareholding percentage is here as per the memorandum 25% each, and these are the authorized capital and these are the paid up capital. You already know what is authorized and what is paid up. Authorized is the official, written legal capital, okay, maximum capital written in the MOA or articles of the company. So this is not paid. These capital 250k each means 1 million US dollars, not yet paid by the partners. Whatever they have paid is paid up capital. 125,000 each they have paid. They have paid 125,000 each, totaling 500k to run the business. Okay. Now what entry you will pass? You received 500,000 from all these four partners, 125k each. What is the entry? So now think, you are the artificial person, you are ABC company limited, you received cash of 500,000 as capital from these four partners. So what you will do, because you received cash from these, so what is happening is you received as a capital. Capital is a liability account, so capital is increasing. What you will do, you need to credit capital account. And which account you will debit? So what you received here, 500,000 in cash. So your cash or bank account, whatever, is increased. So cash or bank account is an asset account and that is increased. So you need to debit that account. Now the entry will be what? Yes, cash or bank account debtor to capital, right? Okay. Now this cash account or bank account debtor to capital account, we will book like, okay, this company, ABC company, has a bank account. They received the 500,000 loyal bank account, and the capital accounts of A, B, and C or whatever you can book all together in one account also. It's not a problem. Okay, so the first journal entry of a startup is booking the capital. Okay, so we have created, or we have identified the journal entry, and we need to book this one into your accounting system or ERP, wherever. So go to your accounting ERP and search for those account numbers and debit and credit those concerned accounts. So once you book and post, you can see the same. You can print the trial balance. You can see the trial balance like this. Loyal bank account is debited with 500. So this is the trial balance of ABC company. Okay, so this 500,000 is debited here, and 500,000 is credited into the capital. So what happens here is you got a bank balance, at the same time you got a capital from the partners. Okay, now what we are going to do is we will explain each and every entry. At the same time we will post into the trial balance also. Since we don't have any ERP, we are not going through ERP, because if we are going through ERP, you will not understand the underlying concepts, underlying entries, what happened and how it is booked. Since we are all booking in directly into ERPs and we don't know what is happening inside. So just open that, each and every entry will be manually entered here in this trial balance to understand the concept. Okay, now there is an investment, we received an investment and to run the business. Okay, this is the first basic entry. Second entry here, ABC company bought inventory for 60 days credit, that is credit purchase. from Messrs. A.com amounting to 300,000, 300k USD. Okay. So the items are mentioned here, 300 PCs at the rate of USD 1000 per PC, 1000 USD each they bought. So this is there, it's written, it's clearly they instructed us, it is an inventory. So our business is selling computers. Okay. So we bought 300 PCs. So what will happen now? This is not these PCs are not for our own use or not for employees use. It will be for selling purpose. So it is our stock, it is our inventory. So scrutinize that entry and identify the journal entry, how it will be. Okay, what is happening here is our inventory account will increase, stock will increase. Inventory account is an asset account. If an asset account is increasing, then debit that account. Inventory is increasing, then debit that account. Okay, asset, inventory account is asset, so debit that account and credit accounts payable. Accounts payable means it is a 60, it is on a credit purchase, 60 days credit. So this is payable, this is a liability, the liability is increasing. So if the liability is increasing, then we have to credit that concerned liability account. So the entry is clear. Inventory account, asset account increased, and inventory accounts payable account also increased, so we credited. So both asset increased and liability also increased. Now this transaction, for this transaction, let us see how we can book this trial balance in the how we can see after posting into ERP or into the accounting system, how it will affect, how you can see the trial balance. Okay, so go to inventory account and book 300,000. So you can see where you can see the inventory account in asset side. Okay, debit, right? So let us take this 300k here. So our inventory, we got inventory, debit balance means 300,000 inventory is there, and the second one is versus A.com accounts payable 300,000. So let us go to our trade payable. It's a liability, so it's increasing the liability, so let us credit this with 300,000. Okay, so after posting, if you are manually doing this, so to understand the concept, better you do this one yourself manually, and after posting all those journal entries, whenever you post a journal entry, just check whether debit and credits are matching in the trial balance. If it is not matching, then you need to check, because this is now just only 2 entries. You'll not have any issue now, but in future, once you have multiple, hundreds of entries, so it will be very difficult to find out the error. So our main objective is to understand the concept. That's why we are going through these manual steps. So if you have any doubts, any issues in understanding these concepts, then just let me know, then we can discuss for a solution. Okay, now we have booked 2 entries into trial balance. So we got the trial balance. Okay, let us see how these 2 entries impacts the income and expense and balance sheet. So what is income and expense? Income and expenses are here. You can see in the chart of accounts, income and expenses yet to come. We haven't booked any income or expenses yet. So these are all purely balance sheet items. Whatever from retained earnings and up or balance sheet items, we have booked 2 balance sheet entries here. So we haven't done any business yet, but we have received our stock and we have received our capital, we have received our stock also. We haven't do any business. So once you start the business, you can see the income and expenses here. Okay, now, so where you can see these accounts in financials, in balance sheet, you can, of course, you can see the impact in balance sheet. So let us see where this 500,000 in cash and bank balances, debit and credit in capital. Okay, in the balance sheet you can see 500,000 in cash, yeah, 500,000 in share capital. So these are assets. Up to this, these are assets, and here you can see capital, equity, and here you can see liabilities. Okay, so the 500,000 is cash and bank balances, and share capital is written as, here it's 500,000. And the second entry also, inventory, we got an inventory of 300,000. At the same time we got a liability also, payable to a.com, 300,000. So our assets and liabilities tallied, balance sheet done. Okay, so for these two entries we have done, and now we have to do some business. We have to sell our computers, or you have to pay the salaries or whatever. So for the time being, now for this video, we are going to sell 25 PCs to Shah Enterprises at the rate of 1,200 each. Okay, we are selling these 25 pieces to Shah Enterprises. Can you assume, can you identify the journal entry? What will be the journal entry? Okay, the journal entry is written here, of course, but let us discuss this. Sold 25 pieces to Shah Enterprises. To whom we sold? To Shah Enterprises. And this is, just remember, it's a credit sales. It's not on cash. It's not a cash sales. It's a credit sales. So what happened here? We sold 25 PCs to Shah Enterprises on credit. That means what? What happened is our inventory decreased, right? Our inventory decreased, and at the same time our accounts receivable increased. Accounts receivable increased, inventory decreased, and revenue increased, right? Revenue increased. Okay, now for sales there are two journal entries here. Let us identify those two journal entries in detail. Okay, first you can see sales to Shah Enterprises. So open sales to Shah Enterprises means sales, credit sales to Shah Enterprises. Okay, so the value is 25 into 1,200 equals 30,000 credit sales to Shah. What does that mean? So credit sales to Shah means they became our debtors, right? Debtors. Accounts receivable, right? Debtor means accounts receivable. That money is receivable from Shah. It is an asset account, right? And there is an increase in this asset account. Accounts receivable asset is increasing, so we have to debit what? Debit Shah. Debit Shah Enterprises. And credit what? Credit the revenue, because the revenue is increasing also, right? Debit Shah and credit revenue. That is the first entry here. Because why we are debiting Shah? Because as asset, it is an asset. The asset is increasing. Accounts receivable, okay, it was 0, now it is 30,000. Accounts receivable is there. Revenue account was also 0, now we got revenue also, and that is also increasing. So debit show 100%, credit revenue. Now the second entry, all this 30,000, we sold it, we bought it for 1,000 each, and we sold it for 1,200. What is the difference? 200 is our profit, 200 is our gross profit. So we need to identify that, how we are going to book that profit. Okay, what is our cost? Cost is our cost of those computers, 25 into 1000, it's 25,000. Okay, so like we have discussed earlier that there is a decrease in inventory. We haven't shown any decrease in inventory here. This is just purely we have identified our accounts receivable and revenue only. Now we haven't shown any inventory, right? We haven't shown any decrease in inventory. So what? So this transaction we have to show a decrease in inventory, means you need to credit the inventory account. Credit the inventory account. Inventory account is an asset account, like we have discussed. Asset account, if there is an increase then debit, if there is a decrease then credit. So credit the inventory account and debit the cost of goods sold. What is cost of goods sold? What type of account is that? Exactly. So cost of goods sold we have debited. Cost of goods sold, you can see this is it is not a revenue, it is an expense, right? It's a cost, right? So it's cost of sales. So revenue is here, cost of sales here. Okay, whatever we have paid for the goods, cost of the product, that is called cost of sales. So we paid 25,000 for those 25 PCs, right? So we have to identify that cost in here. It is 25,000. So the journal entry is cost of goods sold, debit, and inventory credit. This cost of goods sold, if it is increase in unit to debit, so we haven't shown here, like this is like an expense account. So if there is an increase here, you need to debit this. Okay, this is not a revenue account because mistakenly we have highlighted here as a revenue account. So this is cost of sales. It's for the time being you understand, like it's an expense account, whatever cost we have paid. Or if you know what is cost of sales, then better, I don't need to explain this one more. So cost of goods sold, cost is our, this cost of goods sold, cost of sales will include freight, customs, whatever expenses we have paid to bring the inventory, to bring the goods into our warehouse or into our company, and whatever expenses we have incurred during that sales, that is cost of sales. Okay, now because we are going through the basic concepts, I don't need to explain this one again to you, so you just consider this an expense account for the time being, and going forward we can explain or you will understand better. Inventory is an asset account of, okay, now going back to the golden rule, you can see what is golden rule says. If there is an increase in expense, you debit that. So if there is an increase in cost, you debit it, and there is a decrease in asset, we have credited. Now these two entries we need to book into the trial balance books. Okay, these two entries we will show in the trial balance. First one, accounts receivable 30,000, accounts receivable, so it's an asset account. is Shah's account will be debited because it's increasing. Transactions 30,000 and revenue increased. This is sales account, this is called revenue, right? Sales. So here 30,000 is credited, so we got a revenue here. Now the second entry, cost of goods sold, it's an expense. Cost of sales account, so 25,000 is debited. 25,000 is debited, and inventory decreased. Inventory decreased means you need to credit the asset account inventory. So we will credit inventory with 25,000. Now just check the trial balance. It's tallied 855,000. Okay. Now let us see the impact of those two entries in the income. Okay. So here this is the statement of income. Whatever profit and loss or statement of income are the same. Revenue. Do you have any revenue in trial balance? Of course you have. So this is the total revenue. 30,000 is the revenue, and you have cost of revenue or cost of goods sold. Got cost of goods sold also. Cost of goods sold 25,000. Yeah. So your gross profit is 5,000. So this one we can calculate manually also, because we got 25 PCs at the rate of 1,000 and we sold 25 PCs at a rate of 1,200. The difference is 5,000. So this is just only two entries, so we are just checking whether it is correct or not, and we know it is correct. Even the main objective is to understand the concept. So whether there is one entry, two entry, three entry, hundreds of entries, the same concept we need to follow. It's very simple, very simple. Identify the journal entries properly and book those journal entries into the concerned accounts. If there is no account, create an account, then book it, then see how it is affecting the income statement, then also see how it is affecting the balance sheet. Now here, so the trade receivable already came in 275,000 inventory, because it's already given. I have given minus trial balance F11, means we have already booked this 25,000 into the inventory. So how much is our inventory? 300 minus 25, because there is debit and credit. 275,000, you can see 275,000, and there is a trade receivable from Shah 30,000, which is also, you can see, already booked. This is from Shah 30,000. In the balance sheet you can see 30,000. So inventory decreased, trade receivable increased, because this was 300, now 275, because 25,000 stock has gone from inventory, and the trade receivable came in. On this 25,000 gone, this 30,000 came in. The balance 5,000 is our profit, gross profit. So balance sheet, this balance sheet tallied 805. Okay. Now just if you are working in an ERP or in an accounting system, you can also update your inventory account. So this is the first purchase. Yeah, so first purchase of 300 computers at 1,000 each. So this is the initial stock in 300k, and the sales of 25 PCs to Shah 25,000. So this is your total inventory 275,000, which is showing here in the balance sheet also. So always remember one thing: 275,000 inventory, this is your general ledger balance sheet, And if you go into in your ERP or accounting system, your inventory account subledger also must show 274,000. If there is a difference, that means there is something wrong. So always tally this. And another one to tally that accounts receivable. This is your GL. Accounts receivable is 30,000, and you take your aging of Shah Enterprises, because now we got only one client, one customer. It's Shah Enterprises. Their account shows 30,000. So if there are multiple clients, customers, this accounts receivable balance must match with your accounts receivable aging also, because this is our general ledger. So the sub ledger accounts also has to match with the same number. These things all these things we will discuss this one in detail. Each and every point, each and every concept, we will be discussing these things in detail. Okay, now just after these three entries, these three, we have entered only these three entries, right? So just let us see how the changes in equity affected. So the share capital brought in by four partners at 250k, at 125k each is 500,000 first initial share capital, and then no further injections, no injection during the year. So accumulated loss, because we are just a startup, there are no accumulated losses in previous years. So total profit for the year is 5,000, which you can see in the income and expenses, 5,000 net profit. So we haven't paid any salaries, nothing paid yet. So we will be booking all those entries in future, in the coming videos. So this is how our statement of changes in equity is. Now first, this is just a brief introduction about what we are going to do. Okay, so this primary expenses we have had to discuss. It's nothing, just book the primary expenses, and if the expenses were paid by the partners, you need to debit the preliminary expenses and credit to partners current accounts. These things, all these things we will be discussing in the coming videos also. So just you can follow the video if you like, or if you don't like, just comment me and let me know what we can do to do better. Yeah, okay, thank you guys, thank you for watching. Bye.